this time. Hello, guys, and welcome to Macro Monday. We are going to delve into a little bit of what the Fed is thinking, and a really awesome tool created by CME. It's the CME forecast tool that you can look at if you're curious what the derivatives traders and interest rate traders are thinking in terms of, well, what do they think is going to happen? It seems like sometimes the market can give you a pretty good consensus forecast that if you try it on your own, you may or may not come up with a remotely good idea on. So we'll cover that in just a little bit. But to recap where we're at, we are still in a phase where the Fed is being extraordinarily aggressive, maybe not as aggressive with the full 3/4 point raise, but they still seem hawkish, as we can see from the last Fed speech. And some unique Q&A after the I think it was a Press Club or Washington Economist Club, I can't remember which, but there was a great Q&A video of Jerome, talking about where they're looking. And again, to recap where we're at, we believe that the Fed is essentially willing to overshoot on the upside. They really will be happy if, as long as they are ahead of the curve. They just don't want to be in a situation where, okay, well, we stopped, and they don't want to be in a situation where they stop too soon. So essentially, that's the core thesis that you can keep in mind. And again, I don't know about you guys, the Phillips curve stuff still seems to be not working for them at all. A ton of resilience in the job market, with the caveat of additional layoffs in the tech sector, which is really bizarre because usually layoffs happen down chain, and it seems like the layoffs that we're seeing anecdotally are much more tech sector focused to this point. And then definitely, if you guys see any data points on that, I'd sure love to hear what you've seen and what you're hearing, for sure. But for sure, let's turn now to the CME tool that I'd love to share with you guys. This is a really awesome find this week. Can help us get a little bit better feel for where the market is looking. 1 second here. And I will actually drop this tool itself into the chat here. So if you want to take a look at this after the meeting, you can definitely check it out, or you can follow along at home. And indeed, that might be fun, Dana. At home Federal Reserve game or something like that. That might be fun to do. All
right. And a lunchbox.
There we go. And action figures, a J-Pal action figure. I haven't thought about that. That would be sweet.
A little plastic steel cage.
Yes, that would be awesome. Okay, it should be on the screen now. Guys, what's really fascinating about this tool, it gives you a bunch of different comparison tools, and then it does go out here for the rest of the year in terms of the different Fed forecasts. So we can go to probabilities here. I think for me, this is my favorite screen because it shows where everybody thinks the target rates, and I'm not sure if you'll be able to see it necessarily on the screen. Is that showing up yet, Dan?
Yeah. So we got Fed fund futures, meeting probabilities, total probabilities.
And so it gives us a distribution of where everybody is kind of coming down on where they think the meeting will go. And what's great about this is it does go out into the futures market here and give us a little bit of insight on what they're thinking in terms of, okay, this is where we think it's going to break down. Also, let's see, the current tab. And then this is for the March meeting. So they basically said, okay, the Fed said they're going to raise half a basis point, more or less. We believe them. The market agrees. And so 92% chance that it's going to be at the 500 basis points point, or I'm sorry, the total, it is in bips. Okay. And then 500 bips. And then there's a chance that they raise a quarter point in terms of where they're going, in terms of above where they're talking about doing. So there's maybe a surprise upside, and then we'll go ahead and play that out on this chart. And so we can go on out to the May meeting. And this is where things start to get a little more interesting. We break it down into, okay, where did it go? There it is. All right. And then we see a little bit more diffusion. Everybody still thinks the target rate will be between 500 and 525 bips. And 23% chance that it'll be a little bit less, and then a 5% chance they'll go to the upside here. So again, pretty much thinking they're going to be credible with this. And then let's go ahead and skip all the way out to November, where things start to get really fascinating in terms of, well, what do we think is going to happen? This is where you start to see a little bit more diffuse, a little bit more opinions spreading out, but still, again, the 500 to 525 basis points. So as you can see here, it's pretty much getting close to the flat point. I would argue that what the expectation is here. And we do have a really great quant on the house tonight. Joris, if Joris would love to comment, I'd love to have Joris's comments so far. And if he's seeing anything that would make this sound great, or if he's seeing anything that would kind of contradict what we're talking about tonight, I'd sure love to have Joris's opinion, because I certainly more of a pro quant than I am. I'm an at home hobbyist quant, but Joris is the real thing, and would love to have him on if he has a chance to unmute here. We'll see if we'll get a chance to talk to him a little bit about it. But so far, any questions about the CME tool, or any questions about what we're working on tonight?
I saw some acronyms on the previous page. It was like ZQH4. There was something seemed kind of obnoxious. I think it was in.
Yeah, I think it was on the probabilities page.
Yeah, I think you're right. Yeah.
Yeah, along the top. I think these are.
So, okay. So I don't see so G3, H3, J3, K3, M3, N3, Q.
And I believe these are different futures contracts you can buy, but I don't know that for sure. That's my understanding, and I guess that's the
They're
quote.
Alphabetical.
Yeah.
And skip certain letters like L and I and, well, fun. So it might just be a catalog number.
Yeah, that's basically what I think it is. It's like, if you want to buy this contract, this is the ticker you ask for, and that's what they run by. I believe that's what those are.
Okay. Yeah, I've never seen that before.
That's sure enough. And so anyway, I just wanted to share that tool with you guys tonight. I encourage you to go check it out if you get bored and want to kind of see where things are going in terms of the Fed watch and what's going on with that. This is a great tool to see where some of the forecasts are coming out. And again, it is a little bit more in the weeds than I think most people probably want, but for sure it's there for us. All right. Any questions so far, guys? Any comments on what we're working on tonight?
This is my first Macro Monday, so I'm just taking it all in.
Oh, welcome, Yasmin.
Thank you. I wish I could stay the whole call, but I'm taking it in as long as I can stay till my next one.
Don't worry. We'll have plenty of time to give you a headache before you go to the next meeting.
Sounds awesome. I'll take you up on it.
Thanks. Just love a nice headache from my meeting. Thank you. I really appreciate that.
Exactly.
No, what we're trying to do is just get in the weeds a little bit and kind of decompress to the extent we can. Some of the more geeky macro stuff that you hear. It's like, and here's a fun counterpoint to all this. I love this macro stuff, but there's a great investor called Howard Marks, and Howard is very much in the Warren Buffett style of investing. And they more or less think it's literally impossible to trade this stuff that we're talking about. And even they did I was just reading something today about George Soros is arguably the best trader of macroeconomics ever, right? Arguably his track record was that good.
Yeah.
He has a 70% loss rate. So Yeah, I don't know that I want to play a game where I'm probably losing 70% of the time. So that's the counterpoint of the stuff we're working on is like, okay, do we want to trade this? I think there's a difference between trading it and then getting defensive in your portfolio. I think that's more what I'm trying to shoot for. Why we're talking about this is like, okay, if we're gonna, like, for example, are we okay to float rates? Now, I don't know if floating rates is always ever a good idea, but if you say you wanted to buy a property and you had an adjustable rate, is it maybe okay to do that now? And there's an argument out there that says, you know, it might be okay to float now. Because I think if you look at the long-term curve, it's definitely heading back down pretty soon. I don't know how fast that's the question, how soon it goes back down, but the rates are going to be going back down pretty soon as the repercussions of all the rate hikes kick in, the economy contract. And so there's a really good argument for that. But again, the question is, how certain are we on that? And that's another part of what the fun of this discussion. How certain are we that the accuracy of that forecast?
So what do you use as units of measurement for certainty?
That's a fantastic question. I think the standard answer would be some sort of sigma, you know, the statistical, 2 sigma, 3 sigma out from the norm. And there are some really geeky formulas, and I've halfway tempted to get in them and halfway say, nobody wants to see this formula, Doug. Nobody needs this formula.
It's like the computer just does it and you just plug it in and that's it. Like
there's definitely some statistical measures called like the Sortino ratio, for example, that gives you an idea of risk adjusted what these returns are.
Ironically, even though I studied engineering, statistics was like the one subject I almost failed in. I don't know why calculus made sense to me, but statistics just did not. But like I just trust the computer.
It's fake. It's psychology mixed with numerology.
Maybe that's why I didn't like it. I liked calculus.
See, Dan, you're talking about Bayesian statistics, which is my thing. You're talking more Bayesian there. Okay, so that's a fun topic too. The difference between Bayesian statistics and frequentist.
Well, I'm dovetailing statistics into finite math.
Yeah.
Okay. And so like that whole category, it's like, all right, but like, yeah, once you get into imaginary, but this is your show.
Well,
but since this is
a good topic though, it's a really good topic because really what you're trying to determine, and this is why statistics and all this stuff is really controversial in a way, because looking backwards, you can say, well, we have a bell curve here. Well, we know it raised in this bell curve. All right. Well, are you willing to bet on the farm on that bell curve? And that's the trick. That's when it starts to get really like, ooh, do I really believe this stuff enough to bet the ranch on it? And so that's why I think this is where the Bayesian stuff gets a little more interesting, because you can do a little bit more intuition based things, and you can do more simulation instead of just saying, well, it's based on the past. You continue to update with Bayesian statistics. You update your prior and try to be more realistic, and that's my personal belief about Bayesian statistics. It's much more realistic overall. So that's essentially what we're working on tonight. And my argument in terms of frequentist versus the Bayesian argument, I tend to lean again in favor of the Bayesians. And again, Joris would be fun to talk to about this to see if he can unmute and come on camera. I'd love to chat with him about that, but I think he's available here.
Yeah, I'm available if you can hear me.
Hello, Joris. Welcome.
Maybe you can see me right now.
Yeah, you sound good.
No, the one thing that I wanted to mention about Soros, you mentioned 70% loss rate. Okay, I mean that's not necessary. That 70% doesn't mean much specifically because is making money, overall. And what does it mean is that his return distribution is what we call positively skewed. So he accumulates a lot of little losses, but when he hits it, he makes a lot. And that's that's very typical of trend following strategies. For instance, you try to accumulate along the trend, and if it works, I mean, you'll make a lot of money. If it doesn't work, you just decrease your position size and you reduce. So that's probably exactly what it does. Accumulating a lot of insignificant losses, which hurts his percentage of losses. But at the end of the day, you just make home runs all the time. well, 30% of the time, let's say.
Okay,
And
so
that's
Joris,
really-
what you're
that's
saying
more than
is
enough.
his asymmetry was really good though. So even though he was taking, losses, a bunch of losses, the asymmetry was all on the upside. So when he did hit, he went really, really high, skewed to the high end.
Exactly. Yeah,
Nice.
because usually you can separate trading strategies within two categories: the positively skewed and negatively skewed. So positively skewed is just what I described. Trend following. Very often, you have some convexity, and it's pretty safe just because again you have multiple small losses. I mean, it's safe because despite the number of losses, these losses are small, and this gives you some time to assess the viability of strategy. On the other side, you have more the arbitrage strategies. We are more mean reverting. So when you're doing some mean reversion, what you do is that you do exactly the opposite. You accumulate a lot of small wins, but when you get hit, I mean, it's the end, right? So you have a lot of small positive performance, and a huge crash, and that's not the kind of return that you want. But at the same time, from a marketing point of view, specifically for hedge funds, it's more interesting because when you're doing this, let's say you're lucky enough to have 2 or 3 year track record without any major hit. You have a very high Sharpe ratio, and all your statistics that you can run on your track record are up to the roof, and that makes it much easier to sell. But very often the investor doesn't exactly know what's invested in, specifically the crash risk on the strategy. So back to Soros, I think that's what it has, and so I don't see the percentage of losses versus percentage of gains. Well, the number, of trades, really significant in this context.
And Joris, just for the record, are you into a Bayesian framework as much, or do you find kind of both useful in their own contexts?
I would say it's more Bayesian approach because again it's updating all the time. With every new information, I update my I don't like to say predictions, but my statistics and so on, and that gives you, so every single day I have an updated view on the market on what I expect it to be in the near term.
And Joris, just one final question. It could probably keep you here all night. Just peppering you with information, and I find your background fascinating. But for the average real estate investor, is there anything quant can really add to our analysis, or there's really, would you say there's probably not a lot of use in going there even?
For a real estate investor, for me specifically, I'm a pure quant. So I don't do any kind of fundamental analysis. That's not my thing. I don't know anything. For me, the only thing that I see is the series of prices. That's the only thing I can see. What I think that can be interesting in the real estate market is that it just doesn't change overnight. It's kind of a slow moving picture. So I don't know much about the real estate market, but I guess you don't get a crash of 20% of price in houses overnight, right? So the market itself evolves much slower, I would say, and you can probably implement some purely quantitative strategies to give you an idea where the market is going, or if at least it accelerates on the upside, it stopped going up or going downside. For me, if I had to invest in this, which I don't do, just for the record, I would implement something like this, and based obviously on rates and prices on the real estate market itself.
Mm-hmm. Well, and it's interesting to me. I find real estate fascinating from the standpoint that debt is such a huge function of your risk profile that it's not quite the same as equities from that standpoint. So I find that to be a unique distinguishing factor, is how much debt really can drive your risk profile. If you're levered 95% on, let's say, a development deal, with a three-year lead time. Your lead time between your forecast and your reality is so long, where so many bad things can happen. So I just find that fascinating, and I really haven't delved into the really getting down into the weeds and saying, well, how could we model this differently? But it seems like that the debt part of it is so
I think
important.
that there are a couple of things that you can model. The prices. For me, if I had to do it, I would probably trade quantitatively a real estate ETF, something like this. And then after that, I would dive into the pure real estate market. But yeah, that's how I would approach it. I just cannot tell you much more about that, because I've not even tried. That's what I would approach the problem. But I guess that if you look at the prices of real estate itself, I think it's slow moving enough. When I mean slow, so again, like I said, it's going up, then it flattens, and then it goes down. And I guess that you have the time to figure out where the market is going. My guess. I don't know.
No, I think that's right. I think that's why real estate is significantly easier to get some kind of insight versus the market, whereas it feels like that the movement of equities, for example, moves so quickly that you really have to be plugged in and paying attention, where real estate, you can think about things for a while and not really be too damaged. What if you're trading equities, you could, if you don't have
I guess on the real estate side, it could be a monthly strategy. You check every month, and that would probably be more than enough.
Yeah, absolutely. Well, I'd like to welcome to the call my co-host Dylan has joined us from a family event and was able to make it. So I would like to welcome Dylan to say hello, sir.
Hi, I got like 15 minutes, maybe 20. I'm still here at the event, so gotta get.
Okay, so I really appreciate that you duck in, because it could cause some drama at the table. Like, what are you doing talking to these weird people on the internet?
No kidding, especially you.
Yeah, especially me.
The parts I would actually add to Joris, and I'm in complete agreement with there, is the types of things that you look at, such that as sector specific or location specific in the real estate market. Because as we know, as real estate investors, if San Francisco gets hit, that doesn't mean Dallas is going to get hit. So it's very sector by sector basis, and looking at those median home prices in there, the average rents, employment growth, employment degrowth, inflation acceleration due to area and region specific events that are happening. I think in a quantitative aspect, and being math, it's very important to look at, especially at least maybe before buying. Not so much I'd say 100% 2-3 years into your deal, but pre-buy, I definitely say that's there. And then you also have your things whenever you're looking at debt that's not super important, but we do have overnight index swaps that are traded, future implied volatility of inflation and interest rates that go on out of the ECB or the Fed, doesn't matter who it is, and then forward Fed funds looking rates that can all be quant related to kind of play into your thing. But other than that, outside of those specific things to kind of watch and look at, in that real estate specific area, I think Joris hit it, the nail on the head there.
All right, we'll see you, Yasmin. Have a good one.
Bye, Yasmin.
Joris, I am curious. Are there any sense of that what the Fed action does? Does that affect anything on your quant side, or you just basically have your models built to such that the Fed really is not going to hurt you because you're more or less modeling the variability there?
No, the Fed impacts me just because, so these days I'm more focused on the cryptocurrency side now. And, but the cryptocurrency has moved to risk on, risk off asset as well, risk on asset, basically. So anything that impacts the stock market impacts the crypto market now. So the Fed definitely has, an impact on the decisions. So the Fed says something, it impacts the stock market, which impacts the crypto market, and it's virtually instantaneous. And specifically in the communication age that we are now, and that's why, you know, I don't really pay attention to fundamental market, because I'm much more short-term oriented. And when I say short-term oriented, I'm trying to figure out prices for the next 3, 4, 5 days, 2 weeks most, not much more than that. So the fundamentals don't matter at all. It's all, you know, price movements, statistical noise, and that kind of thing. So yeah, so when a Fed is speaking, usually, you know, you have an increase in volatility at the time that the Fed is speaking, and it obviously impacts everything that I do. Yeah.
And Joris, if you were to recommend a couple of trading books that you thought were really great that could give you an insight into what you like, is there anything that stuck out that you're like, that is a must-read set of books?
It depends on what you want to achieve. For people like you that are probably more long-term oriented, I would look at trend following based strategies. I don't have a book in mind for purely quant stuff. You know, there are a series of books written by what's the name of the guy? Ernie Chan. But it's really more, you know, quantitative oriented, so it's probably less interesting for you. But one about trend following, I think that is very accessible. What's the name of the guy?
Is that Michael Cavell's work, or?
So yeah, so this guy is purely trend follower, but on the equity side, yeah, Andreas Klenow. Okay. I have no idea. You know, it's a maybe German guy or something like this.
Okay.
He has written, I believe, 2 books that cover the topic and are very, very accessible. So, and you could implement strategy within an Excel spreadsheet. So that could be a good start, I believe.
That's awesome. Thank you, Joris. I think we're going to wrap up with the recording here, guys, for the record, and then we'll just hang out and network from here on out. But thank you guys for showing up. I'll go ahead and stop the recording here, assuming I can find it.
Yeah, I will have to go anyways.
It's good to see you. Thank you for coming by.
Yeah. So see you next